just a little note. Evidently, if you tried to get to any of the recorded classes that I had posted, you were getting a message that it was private and you couldn't get in. I have since reset the privacy to public. So those links that I have out on Moodle for you to be able to get to classes that I've recorded should now work. If they don't, please let me know and I'll see what I need to do to change other settings. I don't pretend to be an expert at YouTube. I wish I could just put it all into Moodle, but Moodle doesn't give me that kind of room or memory. So I can't even put one class out there. So, all right. Let me just double check something if there's anything else I really care about in chapter 1. I don't think. Well, we were talking about. Yeah, we talked about Sarbanes-Oxley. We talked about social responsibility. I think that's kind of where we left off, is on social responsibility for businesses. And I don't know if I had pointed it out, but I do teach a class in the MBA program about corporate social responsibility. And what I can tell you is that there are very few successful large companies that don't take into account social responsibility. Every one of them is, if you go out and read their websites, they will have a whole section devoted to corporate social responsibility and sustainability. What are they doing to try and make the environment last, to clean the air in the world, to not pollute it to the point where we can't live here anymore. I kind of want to keep the earth livable because it's the only home I have. But most companies are doing something. When you read through their corporate social responsibility and sustainability reports, their CSRs, what you really want to do is you want to read it with a grain of salt and try and decide for yourselves whether these companies are actually doing something. Do they care, or are they just merely reciting things so that it looks like that they care? Because I think in the world today, there's a belief that we want our companies to care about the environment and care about society, to not do things that in a cutthroat and nasty way, profit at all costs. No, that's not the way to do it. And I think companies have found that public opinion, at least, I'm part of the baby boomer generation, and I guess my generation was more involved in trying to maximize profits. But you people that are going to be running the world, is when we step down, you care. And the reality of it is the companies realize that you care, and you will end up voting realistically with your money. You'll spend money and support companies that share your views of the environment and your views of society and how we should be behaving in those ways. So I do think companies realize that, and they realize that they have to do something about being something other than a profit machine. Profit is not a dirty word. A company needs profit in order to stay in business, but companies do realize that they can do much, much more than that. For example, just something that came up in some of the classes that I've been teaching over the past couple of years, Disney. The Disney company is a huge, huge company, massive under anybody's standards. But Disney is doing its part to try and have less of a effect on pollution in the atmosphere. Everybody talks about being carbon neutral and things like that. Disney has done some things to try and put its money where its mouth is. So, for example, they have, and I don't remember how many acres big this is, but in Florida, they have a solar energy farm. And of course, it is shaped like the great mouse because they can't let that go. But it's, a very large solar farm that powers, I believe that it has the ability to power 1.5 of their resorts, talking about Disney World or Epcot or whatnot. So that's a tremendous step in the right direction. So they're not burning fossil fuels in order to electrify the parks so that we can enjoy ourselves on their rides. They're doing something to try and make that so that they have less of an impact on the environment. And that's a good thing. So anyhow, just let that be something that sinks in with you, is that the companies do care at this point. All right, let's see. The other thing we really wanted to talk about, and I think this is really the last thing that we want to talk about. No, it's not. Two more things I want to talk about in chapter 1. The financial markets. When we talk about the financial markets, at least for the companies that we're going to be talking about, we're going to be talking about companies that are publicly traded, okay? So if you are a large Fortune 500 company, you are probably publicly traded, meaning that you have your shares of stock listed on one of the main exchanges, the New York Stock Exchange or something like that, where you have an available market for the sale of your securities. Your securities are bought and sold every day, and people are once again voting for whether they support your company or not with their dollars. Okay, that's what the financial market is really all about. It gives the investors the ability to make that analysis. You know, it's always going to come down to a risk reward calculation. How much risk are you willing to take, and what is the level of reward that you require in order to take the level of risk? So if you want to be in the market and invest your money and have zero risk, you know, there are securities out there for you. Go ahead and buy US government securities, notes, treasury bills, those types of things. The reality of it is that you know, the United States government prints the money and they run the economy, and basically if the government decides it's not going to pay its debts, then we've got bigger problems going on. So realistically, that's an investment you can get into that has, you know, almost no risk. But then again, the reward that you get for almost no risk is very low. Okay. On the other side, you could decide you wanted to buy some sort of corporate bonds. Companies do sell corporate bonds. They borrow money directly from the public, pay interest, and repay the bonds at some point in the future. So although a company like Ford has been around for, you know, 100 years, and they've paid their bills and they've been profitable for the most part and grown into a, you know, a industrial behemoth, it's still more risk than buying bonds from the federal government. So the interest rate that somebody like Ford would have to pay would be higher than the federal government. But Ford would pay a lower interest rate than, you know, some other fly-by-night company that was trying to raise money that had less security. So if you are taking more risk, you demand more reward. So if you want to get into the stock market and buy equities, there's also a risk reward calculation that you do there. What is it that you want if you're an investor? Well, you want two things. You want dividends. You want the company to pay you back every year. You want income coming back to you on a yearly basis through the declaring and payment of dividends by that company, the distribution of earnings, you know, from the owners, operation of the company to the owners. You also want the company to have a growth potential. You want it to be run in such a way that it's going to be continuing on for many years in the future, and that the value of the share of stock that you bought today is going to be worth more a year from now, and 2 years from now, and 3 years from now. Once again, we talked about inflation last class, and you want to make your investments so that you're beating inflation. How do you beat inflation? Well, you get an investment that's going to give you a return that's higher than inflation. If inflation's high, you're going to see interest rates be higher, but they'll never be more than inflation, unless you're taking pretty big risks. How do you beat inflation? Usually in the equity markets. You get payment back in dividends, you get your income on a yearly basis, and you get the growth of the company, the growth of the stock market. So those are the ways that you try to stay ahead of the game. Which stocks are worth more money? Well, what is the company doing? Are they rewarding their shareholders by giving them good dividend payments back? Are they rewarding their owners by increasing the dividends on a regular basis as we move into the future? Is the company continuing to be profitable? Are they paying attention to a lot of the different things that are important to investors? You as an investor have a choice of any of the companies out there. You see a company that you believe has all of the proper ingredients, they're running the company properly, you agree with the politics and the CSR of the company, and it's profitable, it's in an area that you believe is growth, that's going to be more valuable than a company that you feel is not run properly, even though it might be larger and it might be something that's been around for a very long time. One of the companies out there that would come to mind would be something like Exxon. Exxon is a massive company. They are in oil, energy. They're really super invested in fossil fuels. Is that the future? Is that a company that you want to support because you believe that they are polluting the planet? So it might be more valuable for you to make an investment in a company that believes the way you do, that has a promising future, versus a behemoth of a company that has historically been profitable, but who knows what the future holds. You decide, you vote. Your money, where it goes in the market, affects the price. If Disney becomes a darling of the stock market because of profitability and growth and future plans, and everybody agrees with their CSR, then their stock price is going to go up. If everybody decides they hate Exxon because they don't believe that Exxon is the future and they're too heavily reliant on fossil fuels, and that's not what the future brings for the business world, then the price of Exxon should start going down. People should start taking their money out of Exxon and putting it into Disney, or whatever your choices are. So that's what the market's all about. It gives us the ability to have a place so that we can buy and sell the stock regularly. Okay. And also it is a place where valuation is put on the company by outside investors. Okay. The actions in the market will drive the price. Oftentimes, and I have to be careful who I say this to. Sue Middleton hasn't been around for a couple of years now because of COVID, so the investment class hasn't been taught. But if I were to say in front of her that I believe the stock market is basically smoke and mirrors, it's all about attitude and beliefs, she would be very angry with me, because she's got all kinds of calculations that she can go through to show you what a company is going to be worth. But all I have to say is GameStop. GameStop was a company that the stock was basically worthless until some people in social media decided they wanted to punish a hedge fund and convinced all of their followers to buy GameStop, and drove the price from $5 a share to $200 a share. Is the company any better than it was the day before they decided to make it a darling? No, but it's worth $200 a share because everybody wants to buy it. Okay, I believe it's smoke and mirrors, but don't tell anybody I said that. I should probably erase that off the tape. All right, one last thing I want to talk about in the market is the institutional investor, because the institutional investor has really changed what's going on in the stock market. Because see, you think about the stock market and you think about going out and buying shares of stock in your favorite company, and the reality of it is that the majority of the investors that are out there in the equity markets are not individual investors like you and me. First off, for us to get involved in buying individual shares of stock is crazy. You'd have to be, somebody that's a lot richer than I am, and you can tell that I'm not rich enough to be that person because I'm still working. Obviously, if I had more money than I knew what to do with, I would probably be retired and enjoying my time in a place that looks like what's behind me. That's all fake. Remember that. If you were investing in the stock market, and you should, if you've got money to invest, you should be investing in equities in the market. But you shouldn't be buying individual shares of stock. You should be buying basically a way to diversify your investment. Okay, so if I had $10,000 to invest, and I thought, gee, I have to find the company that I think is going to be the best, and I'm going to put my $10,000 in that company, and I decide, you know what, I'm going to buy Facebook. I'm going to put $10,000 into Facebook stock, and then for whatever reason, the government gets all perturbed with Facebook, and there's all kinds of regulatory things that happen that really hurt Facebook's business. What's going to happen to the stock? It's going to drop, and I'm going to lose a lot of money. And if that was all of the money I had for investments, I'm going to be harmed financially. Okay, I shouldn't be putting all of my eggs in one basket. I should be diversifying. So if I had a couple $1 million to invest, I'll put $10,000 in Facebook. I'll put $10,000 in Exxon. I'll put $10,000 in Disney. I'll put 10,000. You know, I would buy I don't know, 20, 30, 40 different stocks in different parts of the investment world. I would buy companies that sold consumers goods. I would buy medical equipment providers. I would buy energy. I would buy, so on and so forth. I would move into different, I would diversify my investments. That way I wouldn't be hurt if any one part of the economy were to take a hit. That's the proper way to invest. Diversify. You have as many different things as you possibly can. To do that as an individual, you have to have a lot of money in order to diversify. Or you go buy a mutual fund. Okay, a mutual fund is a fund where the investors gather money together from people like you and me, and I take my $10,000 and I put it into a mutual fund. And the people who run the mutual fund, they take my $10,000 and 10,000 from 1,000 other people. Now they've got millions of dollars to invest. They have the ability to diversify the portfolio, buy in different types of businesses, even take in buying some fixed income things. So they have some bonds to put against the equity side of things for, to reduce the overall risk that we're taking. Okay. That's how you do it. Okay. The mutual fund. They're going into the market and they're buying the stocks, right? They're buying the investments. The mutual fund is an institutional investor. Okay, it's not you and it's not me, but it's the people who are running the fund, the professional investors. Okay, now that's one grouping of institutional investor that's out there. What else do we have out there? Who else is in the market that's investing in companies trying to get a return? Okay, well, insurance companies. I think I had mentioned in this class that insurance companies don't make money on the premiums. They don't make money by charging you more than they expect your experience rating to your claims to be. They just want to sort of break even there and pay their overhead. The profit comes from the fact that they're holding your money for a long period of time, and they can invest it during the year while they're waiting to make the claims on your policy. Okay, so that's how they make their money. So insurance companies are huge institutional investors that are in the market. Okay, who else is out there? Banks are out there. Okay, banks make money by lending money, sure, but they also have huge investment accounts. They have money that they invest in the market. So the banking world, they are institutional investors. One of the ones that I really haven't talked about yet, retirement funds. Okay, every one of us wants to be able to retire when we get to a certain age. So we're putting money aside, whether it's in an IRA or whether it's in a 401k or whether it's in a plan that has been produced by our employer. The retirement funds are out in the market and they're buying up the investments. Okay, so we have a lot of very professional investment entities out there actually buying up the individual stocks that are out there in the market. Okay, the institutional investors. I didn't do this. I've done this a few times over the years, but if you were to pick a Fortune 500 company and then just do a search as to what percentage of their stock is owned by institutional investors, I think you would find that the institutional investors have more than 50% of the stock. Let me just do that. I'll just pick a company. How about AT&T percent of institutional investors. Let's see what comes back on that search. All right, so AT&T, mutual fund holders. So mutual funds, you and I investing our money, but being run by a professional, 28.12%. Other institutional investors, 25.38%. So between institutional and just, I think it's great, mutual funds are 28%. Other institutional are 25%. That's where you get into the banks, insurance companies, retirement funds and such. So between the two, you've got 53.5%. So individual stakeholders own 0.3% of AT&T. So the reality of it is that the institutional investors are running the financial markets at this point. Okay. Well, you may be in that big group where you're a investor in a mutual fund. I know I am. That's where my investments are. Anytime I've tried investing my money in individual stocks or securities, I was really good at making it disappear. It was kind of a magic act. So I do a much better job putting my money in a mutual funding and letting them grow my money for me. It works a lot better. But that's who's running the market now. It's the institutions. Now, think about this. The structure of a corporation. We have the big base at the bottom. It's a pyramid, okay? The big base at the bottom, the most numerous group are the shareholders. Hundreds of thousands, if not millions, of shares that have been issued by a company. They're all at the very base of our pyramid. Then they elect the board of directors, who are in charge of the long-term running, the big picture people for the corporation, who then appoint the officers of the corporation, who then run it from day to day. Okay. If I owned, my $10,000 worth of AT&T stock, which is going to be some small percentage of that 0.3% of ownership of AT&T stock. How much control do you think I have over the company? Well, I get to vote, right? I get to vote in the elections. I get to vote for who's going to be on the board of directors. Yeah, my vote is useless. It's worthless. It has no value whatsoever. I can't outvote the 55 or 53%, whatever it was, that are the institutional investors. They're running the show. So now what's going to happen is the way the company is going to be run is going to be dictated by those institutional investors. And the institutional investors have the authority, have the power to change who is on the board of directors. If they buy into a company and they don't like the way the company is being run, we think you should be going down this road as opposed to this. We think you should be quicker in how you're releasing your products. If you think you're taking too much time in research and development, whatever. The institutional investors don't like the way you're running the company. In 3 years, they will completely change the entire board of directors, because most companies have 3-year cycles for their board of directors. You get elected to a 3-year term, and 1/3 of your board is up for re-election every year. So at the end of 3 years, everybody would have been up for re-election. And if the institutional investors want to change who's running the company, they'll do it. They'll take out whoever is up for re-election that first year and put in their group of people that thinks the way that they think. Second year, they'll take out the next third of the board of directors and put in their candidates that think the way that they think. So basically, they will control the board of directors within 2 years. And institutional investors tend to think that way. Okay, so if you're an institutional investor and you don't like the way a company is being run, you've got 2 choices: sell, go into a different company, or just take it over. Yeah, so that's what's going on now. And realistically, one of the things that I'm trying to get through is that you have, when you're running a company, if you're either on the board or if you're one of the officers that is a lot of power in the company, you have the choice of being able to make decisions for high short-term profits, or a little less high profit over the long run. And if you want to have the company be valuable in the future, you want to plan for both today and tomorrow. There's a very big danger of people saying, no, we want to maximize profits today and we don't care about tomorrow. And if you have a set of institutional investors that think that way, then they have the ability to ruin a company in the long run. They want to suck what they can out in the way of dividends right now, current income, and let the future be damned. So we worry about that. Okay, but the institutional investors are really running the show at this point. Last thing in chapter 1 is to talk about technology affecting the way that the capital markets are run. Back in the old days, you had the people on the floor of the stock exchange, shaking their fist, and I want 10 shares, I bid, whatever. It's all done electronically now. Okay, so in addition to that, you have long-standing entities that were in the financial market that have been taken over by digital companies, like the stock exchange itself is now more of a digital computerized thing. You can look through that section if you want. It's understand that it's there, but I'm not, this not something I care to test you on. Okay, chapter 2. Chapter 2 is titled Review of Accounting. I don't know how many of you, although I would doubt that it's actually many of you, are actually accounting majors. I don't think you have to take this course if you're an accounting major. If you're a finance major, you do. And other business people may take it. So you may not have as extensive a accounting background as other people would. So we're going to spend a little bit of time doing a review of accounting. No, I'm not going to teach you debits and credits and things like that, but we're going to talk about the end result of the accounting process. Okay, so the accounting process deals with record keeping, right? The job of an accountant is basically a historian. You just keep records for the company. You keep track of transactions. Okay, you're not sitting back and writing the history of the company, other than the financial history of the company. That's what you do as an accountant. You keep track of the money in, you keep track of the money out, keep track of sales, you keep track of expenses, you keep track of the assets of the company, those types of things. You keep track of all of those transactions. And the whole purpose of that record keeping is so that we can write the story of the company at the end of the year, right? So you as the accountant, you're the historian, you're going to turn out a number of reports at the end of an accounting period. Okay, so you're going to turn out an income statement, you're going to turn out a balance sheet, you're going to turn out a statement of retained earnings, you're going to turn out a cash flow statement. Those are the big ones. Okay, those are the ones that we're going to be working with. So let's start with the income statement. Okay, now the income statement is how to describe it. It is a picture of a time frame, and let's just assume that everything I'm talking about right now is a year, but you could have other periods, right? We could talk about a quarter or a half a year or even a week or a month if we wanted to. We could have these tools created, these reports created, but let's just for right now just assume we're doing these all annually. So I'm going to look at an income statement for our fiscal year, and to make things even simpler, I'm just going to use a calendar year as our fiscal year. Okay, so January 1st to December 31st, we're going to end up looking at What did we do? What were our transactions? How did we make out? So what's on an income statement? Well, an income statement is going to keep track of basically two things. It's going to keep track of revenues, income, and expenditures, expenses, okay? Distributions, disbursements of cash. I want to be careful how I use the word cash, because we're going to talk about how that changes. All right, so over that 12-month period, starting just December, or excuse me, January 1st and ending December 31st, I'm going to keep track of all of the sales in the company. Every time we sold the product. All right, so let's make this, those of you who have had me before, you know that, of course, I run the world's best widget making manufacturing company, and I manufacture blue widgets, which are all the rage. Everybody wants my blue widgets, and I have the best widgets in the world. I want to keep track of all of the sales of my widgets. So my accountants are keeping track of that. I have people that deal with accounts receivable and sales side of my accounting. So they're going to keep track every time that an invoice goes out. They're going to keep track of who owes me money, and they're going to keep track of the sales that occurred. How many widgets were sold? What was the price per widget? And those types of things. Then I have a different set of accounts who are going to be taking care of and paying attention to the distribution side of my accounting. I had to distribute money. I had to pay money for certain things to happen. In order to make the widgets, I had to buy the raw materials. I had to buy the steel. I had to buy the paint. I had to buy the welding rods. I had to buy shear parts for my machines. I had to keep the drill bits sharp, so on and so forth. I had to pay the electric bill. I had to pay rent. I had to pay gas. I had to pay salaries for both people who were set manufacturing and for people who were in the administrative side of my business. So the people who are keeping track of that, they're also keeping track of what did it cost me to make a widget. How much does it cost me to make a widget? Well, here's our variable costs. Here's the material that went into it. Well, here's then we also have the fixed costs, the various costs that we have in the business that where they're going to be there regardless of how many widgets we manufacture this month. I got a whole set of accountants that deal just with that, okay? And they keep track of their individual sides of it. Then I've got another set of accountants that really has to deal with both of those other groups. Those are the people generally who are going to be putting the statements together. We'll call them the accountants. The other people, really, they could be clerks. They don't have to necessarily have accounting degrees. They just need to be able to know how to do transactions and repetitive type things. But then I've got the people who have to oversee both sides of the accounting thing. They're the people who are going to say, okay, we need to be able to take the sales from the people over in that department. We have to be able to take the expenditures from the people over in this department. And we need to be able to put together a statement that's going to tell people whether we're successful or not. Okay. Now, who wants to know if we're successful or not? Who's going to be using that income statement? Travis, who's going to be using the income statement?
Potential investors.
Yeah, but even more basic, it's going to be the people who are managing the company, because we want to know if we're actually making money or not. Are we doing this right? Are we charging enough to pay all of our expenses? We need to know, first off, as a management team, are we being successful? And later on, what we're going to do is we're going to try to get a little bit more sophisticated and find out if we're being the most successful that we can be. But the first question is are we even making money? Then Travis, yeah, the people who might be investors, for a publicly traded company, we have to publish our financial statements. We have to send them to the Securities and Exchange Commission, who will then make them available to the public. We should also be sending them directly to our investors so that they feel that we care about them. So yes, our current investors, future investors want to see that. Who else? Is there anybody else that wants to see our income statement? Who else do you think might be looking at our income statement? What do you think, Owen?
government?
The government, yeah. Like I said, we have to turn in our reports to the SEC if we're publicly traded or above a certain size. Sure. Who else? There's another group out there. But I'm sure there's hundreds of groups. Another one I can think of specifically.
Do you think competitors?
Probably they're probably paying attention to what we're doing. Sure, Peyton, that makes sense. Although from a standpoint, I really don't want them to know. But yeah, if I'm required to publish it to the government and make it available to the public, yeah, they're going to see it. Something more direct, a little bit more direct. How about bankers? If you think about it in terms of operating your company, you probably have, we're going to talk about how you fund your company. You're going to fund your company from one of two sources, either with equity, people that you allow to put the money in and become owners and share the profits, or debt. You borrow money from somewhere, okay? The people that we borrow the money from, they want to know if we're successful. If I go to the bank and say, hey, I need to borrow $1 million in order to build an addition onto my factory and buy the appropriate equipment and train my people, and the bank says, sure, well, first off, they're going to look and see, am I credit worthy? Am I profitable? Do I have a business plan that makes sense that I'm going to be able to pay the loan back? But they're going to want to see my income statements on some repetitive basis to make sure that I'm actually doing the things that I said I'd be able to do. Oh yeah, I'm going to do this new building, and it's going to increase my business by 50%, which is going to, since it's going to be leveraged properly, it's going to increase my profits by 60%. I need to prove that. Okay. Now, the people who are out there that would be in the accounting industry, the CPAs, why do we have CPAs in the world? Why do CPAs, what's their job? Well, their job is to audit. Generally, that's the big deal, to audit the financial records of companies. On whose behalf? Who cares about that? Who cares if it's right? Who cares if we're lying or telling the truth? Well, there should be some people that care, right? Government cares. The investors care. The banks care. I may not even be a publicly traded company. I may just owe the bank $5 million. The bank says, you know what? We'll lend it to you, but you have to agree to have your financial statements audited. And we need to see them audited on an annual basis with us getting the audit report. So that the bank wants to make sure that we're doing our, first off, we're doing the business, and second off, that our accounting is being done properly, and that the accountants are going to certify that we're not lying to the bank. And so if I'm a publicly held company, I have to report on a quarterly and yearly basis to the SEC, and those figures have to be audited in order to comply with the SEC rules. But I don't even have to be a publicly traded company to require an audit, because there's people out there that want to make sure that I'm not lying on my financial statements. I could be a small, no, I'm not, if I'm borrowing enough money that the bank's going to make me do audits, I'm going to be a little bit bigger company. But, it could be purely to satisfy the bank that I'm getting audited statements. Okay, so there's a lot of people out there that are interested in these financial statements that we're putting out. So the work of the accounting department, the work of the people who are putting the reports together, it's all very important work. The company would come to a screeching halt if we didn't have the ability to do the recording and the reporting. Okay. If the bank is dissatisfied with how we are performing, there's a very good chance we could end up going out of business. You don't hear much about this, but what you end up with when you get into where you're borrowing money in order to fund the operations of your company, you're going to be making certain covenants. You're going to be making certain promises to the bank that certain things are going to happen or are not going to happen. Okay. And usually there are requirements of certain capitalization requirements. You have to have, you can't rely too heavily on debt, because if you rely too heavily on debt, the banks, the lenders get nervous because you don't have enough to lose. the banks want you to have money in the game too, so that if the business ends up going belly up, you lose money too, not just the bank. Okay, so there's certain covenants that you have to make, certain promises that you have to make in order to get the bank to lend you the money, or even if you're selling in the market and you're selling bonds, same thing. You have certain requirements that you have to maintain. You know how you prove that you're meeting those covenants or not? With your financial statements. Okay, so that's why it's so important. But I want to go back to the very, very first one that I had mentioned, and that's as a tool for management to know, to be able to judge how well the company is being run. Okay, because ultimately, it's a beautiful tool for the current management of the company. We go through the operation of the company. I tell this story all the time. And I've had an interesting career over the years that I've been working. Some of you know that I was an accountant before I was a lawyer. I had an accounting degree from Gannon University. I did not want to go into public accounting. I went into corporate accounting. Was a mistake career-wise. If I would have gone and got my CPA first, that would have opened up a lot more doors for me. But that's why I'm a lawyer, because I realized that I had made some career mistakes as an accountant. But anyhow, trying to remember where I was going before I went off that little tangent. Give me a second here. So anyhow, I had this career, and because I have this accounting background, everybody thinks that I can solve all their money problems as their lawyer. And I had this one client who ran a business, and his business was he sold trailers. And I'm not talking about homes, not mobile homes. I'm talking about like work trailers, vehicle trailers, those covered trailers that you see that the carpenters and the builders and whatnot have, that they hold those types of industrial type trailers, trailers that you could carry heavy equipment on. He had a business where he sold trailers like that. And he had he treated it sort of like a car dealership, where he had a location where he had at least demonstration models of the various types of trailers that he had access to be able to sell you. He would sell off the lot, or he would order the thing for you, depending on a whole lot of different business circumstances. And he was convinced that he was making money hand over fist. I am so profitable, John. This business is so wonderful. But he could never pay his bills. Now, later on, you'll find that that may not be an indication that you're not making money. It could be a cash flow thing, but this guy never seemed to get ahead of the cash flow problem. So he asked me to come in and take a look at his business records, sort of do a informal audit. Not that I know how to do an audit, but I could certainly review his financial records to give him some advice. So I went in and I talked to his accounting department. And I had asked the business owner, I said, what's your gross profit? And we'll talk about gross profit in a minute, but gross profit is your sales minus your cost of goods sold. So it's the profit that you get that funds everything else in the company. It funds your overhead, it funds your taxes, it funds your profit. Okay, so gross profit has to be big enough to pay everything else. And I said, Jack, I said, what is your gross profit? Because he didn't have any financial statements. How he was trying to run the company without financial statements is beyond me, but he didn't have any financial statements. I said, so Jack, what is your gross profit? He says, my gross profit is great. Because I've got 30% gross profit. So that meant that for every dollar of sales, it was 70 cents of cost of goods sold. Meaning he had 30 cents out of every dollar that he sold to pay all of his other expenses, which is a good number. 30% is a really good gross profit. And I said, Jack, I said, with a 30% gross profit, you should really be doing very well. So I went and I talked to his accounting department. I sat down with his head accountant, and we started going through things, and I was looking at the type of expenses he had. And he had a lot of what I'll call luxury expenses because of the fact that he did have a retail view. So he had a lot of expenses, like, the floor mats that you when you walk into a place, that's so that you don't track all kinds of snow and mud into the building. And he had those being replaced all the time. And he had uniforms for some of his people. He was having cleaning, had them cleaned on a regular basis. On and on. It's like, okay, it's a retail thing. He's trying to create a certain look. I can see that. But they were kind of expenses that I thought might not be necessary if he was having problems. But with a 30% gross profit, that shouldn't have been an issue. And so I started talking to the accountant and I said, I don't understand. I don't know, is there some theft going on here, or what's the problem? Jack tells me he's got a 30% gross profit. She looked at me and she said, our gross profit's nowhere near 30%. I said, well, what is it? She goes, I don't know, maybe 4 or 5%. And I said, what? She said, yeah. She said, Jack doesn't understand the difference between profit and cash flow. And see, what was happening is every time that Jack would run into a cash flow problem, he would fire sell something off of the lot, basically just sell it to break even in order to raise cash to pay the current bills that needed to be paid. So he believed he was running at a 30% gross profit, when in fact he was actually running at 3% gross profit. I eventually did do the calculation, 3%, which meant that of every dollar that he was bringing in, 97 cents of it was cost of goods sold, meaning he only had 3 cents of every dollar to pay all of the other expenses, all of the overhead. That's why he was not able to pay his bills. Now, Jack ended up going to jail eventually for some unsavory business practices. And to this day, I struggle to try and understand whether Jack was just really stupid or he was a crook. To this day, I don't know. I represented him in a criminal case and I got him off by claiming he was that stupid. A year or so later, he did the exact same thing, got arrested again. I refused to defend him a second time. He went to an actual criminal defense lawyer who ended up pleading him. He ended up with about 2 years in jail. So he was either really stupid or really crooked. The more time that goes by, this is probably 20 years in the past now, I think he was more crooked than stupid, but I do think he was stupid. Mostly because he didn't understand that he needed to have those accounting tools in order to make decisions. Basically, if he would have had his income statement to look at, he would have seen that his gross profit was not the 30% that he thought it was. He would have seen it was really only 3%, and he could have adjusted the way that he did business. By not having those tools, he was operating on assumptions that were not true. And as a result, he ended up bankrupting the business and going to jail because he didn't understand what was going on in his business. That's me giving him the benefit of the doubt that he was just stupid. But these are tools for management to use. Okay, first blush, am I making money? Another thing that I'm going to tell you, and I guess there's a big difference between working for a Fortune 500 company and working at a smaller business, because with a smaller business, you don't have as much time for analysis and to do up very fancy statements and such. You end up being most business owners aren't accountants. Most business owners are doing the business that makes them money. So if you are, say, an electrician, you're not trying to do the books. You're trying to do the work wiring somebody's house or doing the electrical work for some business or something. You don't make your money keeping your books. You make your money by doing your profession. And as a result, those people have to at some point make the decision that they need professional accounting staff, or at least somebody that's willing to come in to do the accounting work for them, more than just paying their bills when they're due and sending out invoices and cashing checks when the bills are paid. You need more than that. You need more than just turning the shoebox of records over to your tax guy at the end of the year so he can do your tax return. You need more than that. Okay. But the thing is, in the real world, the small businessman doesn't take the time, doesn't value the what you get out of having a professional accountant do the work for you. So that's one of the problems that the small business experiences. That being said, you tend to run the company by the seat of your pants. You feel whether you're profitable. You feel whether you're doing it right. That's really hard. You're much better off having the tools and using them. Okay, so that being said, let's talk about the tools, the income statements. Now, what I want to do is in your books, and let me see. Let me bring it up. I should have access to this. Give me 1 second. No, that's not what I wanted. I guess it is. Okay. All right. The electronic book that I have access to is an older version than the one that you are using if you bought the textbook for the course. What I want to do is I want to share some of the pages that I'm looking at with you. So give me a second. All right, so on your screen, you should see something that is labeled the Kramer Corporation income statement. And like I said, in your book, I think it says 2015, but I think all these numbers are identical for Kramer Corporation for year ended December 31st, 2010, with what's on your screens right now. But let's take a look at this. This is an income statement, okay? So we have lines 1 through 14. And I just want to go through them. Sales of $2 million for this company. Line 2 is cost of goods sold. So there's your cost of goods sold, all right? That's what it's the materials that go into what you're manufacturing. It's the labor that goes into the manufacturing. It's the direct cost of making your product. Okay, line 3 is you subtract cost of goods sold from sales and you get gross profit. This is that gross profit figure that I was talking about with my little story. And I don't have a calculator with me, but if you were to take $500,000 and divide it by $2 million, what's that going to be? 25%? I think it's 25%. So the gross profit margin for Kramer Corporation is 25%. All right, that's not bad. It may or may not be enough to give us profit. Let's go and find out. Line 4 is selling and administrative expenses. Okay, now this is made up of a lot of different general ledger accounts. So it's going to be payroll that's not involved directly in the production. So the people who are working on the manufacturing floor, the people who are running the machines and things like that, their salaries are going to be in cost of goods sold. This is going to be like the office staff, the accountants, the secretary, the receptionist. This is going to be the salespeople that I pay commission to go out and sell the product. This is the cost of renting the factory building. This is the electric to keep the lights on. This is the gas to keep it heated. This is office supplies, insurance, all of the costs that are secondary, that are not directly related to the cost of goods sold, are in my selling and administrative expenses. For Kramer Corp in the example, it's $270,000. Additionally, I have depreciation expense because I'm a manufacturer. I have some machines that I use in the manufacturing process. Depreciation is line 5. All right, so then line 6 is operating profits. So I'll take my gross profit of 500,000, subtract the selling and administrative of 270, subtract the depreciation of 50. That gives me an operating profit of $180,000. You'll see in parentheses on line 6, it says EBIT, E-B-I-T. Now, in the finance world, we use these terms. It is the operating profit of the company, but in finance, we call this EBIT. And EBIT stands for earnings before interest and taxes, because interest is one of those expenses that we want to be able to separate away from our operations, because if we want to be able to tell whether we're doing all right in whether it was a good idea or a bad idea to borrow the money as opposed to sell off new equity, we want to have interest taken out of the equation. So we want to have our operating profit before the cost of interest for our financing. Okay, so interest expense is line 7. In this case, it's $20,000. We subtract that from EBIT, it gives us $160,000, and this is earnings before taxes, EBT. Okay, now I'm going to hold you to understanding the process to get to where we are. Okay, this format that you are looking at right here is what we are going to be using this semester whenever we look at an income statement. We're going to have sales minus cost of goods sold, giving us gross profit. You got to get to line 3. That's the first big landmark in this form. Then we're going to take out our overhead, selling and administrative, and depreciation to get to EBIT. You need to get to EBIT, earning before interest and taxes. Then you have to take out the interest, because it is a cost of doing business. It is deductible. It's all those good things. So we then take out interest to get to earnings before taxes. Then guess what? Taxes. If we had profit, we're going to have to pay the government. All right, so taxes is line 9. In this case, it's they calculated it out to be $49,500, which then gives us line 10 in our example, $110,500. Earnings after taxes, EAT. That's another landmark. Okay, now sales is a landmark. Cost of goods sold is a landmark. But our first big landing point of a number that's going to mean something to us as finance people is gross profit. Then we take out these other expenses. Our next big landing point, a big landmark, EBIT. Take out interest. Our next big landing point, landmark, earnings before taxes. Take out taxes. And really, what I want to refer to as our final big landing point, but there's still more to the form, is earnings after taxes. Okay, that's a big place to get to, is earnings after taxes. Now, in this particular company's situation, we have preferred stock dividends. And in this case, the example gives us $10,500, which gives us earnings available to common share stockholders of $100,000. This is going to require me to stop for a little while and talk about ownership of stock. Now, on line 11, we have preferred stock dividends. This is one of those things where you may not have it in your company. You may have it in your company, but there are 2 different types of stock that you can have if you are financing a company. Okay, and this is the equity side. These are the owners of the company. If you're buying stock in a company, you are an owner. You are buying equity in the company. If you are a lender, you are a lender, and you'll be part of the loan or liability side, not the owner's equity. Okay. Preferred versus common stock. Now, those are the two different types of stock that you can have. A preferred shareholder owns preferred stock. Preferred stock, because of its name, tells you that it has some certain preferences over something else, and that something else is common stock. Okay, so preferred stock has some preferences over common stock. Common stock, you are the basic owner of the company. You are entitled to the profits of the company as a common shareholder. It's usually paid out to you in dividends. You are entitled to share in the growth of the value of the company. So if the company becomes bigger and better, then the value of your share of stock should grow. As a common shareholder, you're looking for your share of stock to appreciate, to become worth more money. If the company goes out of business, you're an owner and you get paid after everybody else. Okay. If the company goes out of business, the first people to get paid will be the creditors. The people, your trade vendors, your employees, you owe them payroll, all those types of things. Your creditors, the people you owe money to, loans and debts, they get paid first. Okay. If there's money left over after you pay your creditors, the next group of people who get paid are the preferred shareholders. This is one of the preferences that preferred shareholders have over common shareholders. So the preferred shareholders may get paid. If the company goes out of business, that means you're not making money and you're in some deep financial issues. So usually there's not going to be enough to pay everybody. So you're going to run out of money somewhere. I'll be very honest with you. It's rare that you get all of your creditors paid, but if under some weird circumstance you get all of your creditors paid, then the next group of people that get paid are the preferred shareholders. If you run out of money paying off your preferred shareholders, then the common shareholders get nothing. Okay, so there's a preference there. The preferred shareholders get paid before the common shareholders in a liquidation situation. Also, when it comes to dividends, the preferred shareholders, it's kind of strange because preferred stock tends to act more like debt than it does like equity. So for example, you got paid before the common shareholders, just like the creditors got paid before the shareholders. But you're still behind the creditors. So you're not really a creditor, but you're a preferred equity holder. You get paid first in liquidation. When it comes to dividends, when a share of preferred stock is sold, it is sold for a particular value. So I want to sell my preferred stock at values of $1,000 per share, and I sell whatever number of shares I need in order to raise the money that I want. So it's going to be preferred stock. It's going to be sold as $1,000 face value, 5% preferred stock. What's that percentage mean? It doesn't have anything to do with the ownership of the company. What it is it's saying that your dividends will be 5% of the face value of that share of stock on a yearly basis. So if it's $1,000 share of preferred stock, 5%. So 5% of $1,000 is going to be $50. That means that shareholder of that preferred stock is guaranteed $50 of dividends per year, as long as there's money to pay dividends. If you can't pay dividends, then they don't get paid either. But when dividends are paid, they get paid first before the common shareholders. Okay, so there's that other preference. They're ahead of the common shareholders in line for payment for liquidation or even payment for dividends. Okay, now the disadvantage to being a preferred shareholder is you're not going to get any more than that 5%. If the company is doing extraordinarily well and has ungodly amounts of profit, the board of directors may decide to give massive amounts of dividends to the common shareholders. They may declare a 20% dividend, and you're going to end up with 20% of the value of your stock as a common shareholder being paid to you as dividends. If you're a preferred shareholder, you still get your 5%. It doesn't matter what you're going to give to the common shareholders. You get your 5. You're guaranteed your 5 as long as there's money, but no more. And also, the common shareholders, if we as a company are growing and doing better, the value of my share of stock is going to appreciate. It's going to go up in value. Not so much for the preferred shareholder. Remember, it was $1,000 share. It's worth $1,000. That's it. It's not going to share in the appreciation in the value of the company itself. Okay, so in those instances, it tends to act like debt. It doesn't grow with the value of the company, like debt. You get paid a set percentage instead of sharing in actual profits, like debt. But you don't have all of the advantages of actually being a creditor. You're behind them in line for any kind of payment. Okay, so why would somebody buy preferred stock? If you look at it, it's a company that you feel is really creditworthy and is worth having, then you can consider it to be basically a loan, but you're buying equity. It would be dividends instead of interest, so there could be some tax differences. But anyhow, getting back to the income statement here. Line 11 is the amount of money that we had to pay in dividends to the preferred shareholders. Since they get paid first, that money is not available to the common shareholders. That's why it's next on our income statement that we reduce the amount of money that is available to the common shareholders by the amount that is required to be paid to the preferred shareholders. Okay, so earnings after taxes was $110,500. The preferred stock dividends just happened to be $10,500, which gives us a nice round number for earnings available to common shareholders of $100,000 in profit available after we've paid everybody. That's after the government, it's after our creditors, it's after our employees, it's after the preferred shareholders. Now, the rest of it, it's not really part of the income statement, but it's a calculation that we do in finance. Line number 13 is common shares outstanding. There's 100,000 shares outstanding. Well, gee whiz, look at that. They made the math really easy for us in the book. We have $100,000 worth of earnings available to common shareholders. We have 100,000 shares of stock in common shares out there. That means our earnings per share is $1. Okay, so we don't calculate earnings per share on any of these other landmarks up here, the landmark of gross profit or EBIT or EBT or EAT. We have to have paid everybody, including our preferred shareholders, to come up with this number, earnings available to common shareholders. Then we divide that by the number of shares, and that gives us our earnings per share. Now, what is that number? Does that do anything for us? Well, it gives us a tool. As we go through all of the analysis that we're going to do, you end up realizing these are just tools. So earnings per share of $1 per share. All right. Does that mean I'm going to get that money? That mean if I have one share of stock, I'm going to get a check for $1? No, that's the earnings of the company. The board of directors is going to decide how much of that earnings is going to be distributed to the shareholders as dividends, because there's competing interests on that profit there, that earnings available to common shareholders. The shareholders, they'd love to see it paid out to them as income. Oh, that's great. We're going to have tremendous dividends this year. Great. Woohoo. But is that good for the company? When the company is working and trying to grow and build itself, it needs to be able to accumulate the earnings and allow them to grow so that they can start growing the company. Okay. If you distribute all of your earnings every year, it's going to be very difficult for your company to grow. All right. So that being said, let's see what the book wants us to do here. Income statement is a defined period of time. Start with sales, blah, 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 all the things that we just did. Make adjustments, revenues, not related. I'm going to move something off my page here. Okay. So in this company here, the book is pointing out that there are three primary sources of capital. And when we talk about capital, we're talking about how we are funding, how we are financing this operation. The bondholders, okay, the people that we borrowed money from, they received $20,000 in interest. If you go back and look at, remember, I don't remember what line number it was, but we had interest of $2,000. So we had EBIT, then we had interest of $20,000, and then we had EBT, earning before taxes. So that was, we have to keep in mind that we have bondholders out there that we owe money to. And we use them as partial funding of the company. The preferred stockholders, they received the $10,500 in preferred dividends. Okay. And then we have the 100,000 shares of common stock that's out there. So that's three different groups of people who gave us money to run our company. Bondholders who lent us money. That could just as easily be a bank as opposed to bondholders. The preferred shareholders who gave us their money knowing that they were going to have preferences, but they were going to be necessarily treated as owners, but really effectively treated as debt. And then the true owners, who are the common shareholders. All right, so now and just continuing on with my sharing of the page here, the next financial statement that we want to look at here is basically and this is a very abbreviated version of this, the statement of retained earnings. Okay, now I talked about the fact that we've got some competition for what's going to happen to that money, the ultimate net profit of the company, the funds available to the shareholders. The shareholders would like to see some of it at least coming their way as dividends. The company would love to keep some of that money in the company so they can continue to try and grow the company without having to go out and borrow more money. Hey, let's take our earnings and invest it into the company. Those of you that are accountants or remember your accounting class, you remember that there's an account out there called retained earnings. And what that is it's a historical account that keeps track of and accumulates all of the earnings of the company from the very beginning date of the company. So here's your statement of retained earnings. And this is something that's going to be more related to the balance sheet than it is to the income statement. But then some of the numbers are coming from the income statement, so that's why it's here. So we have retained earnings balance at the beginning of the year, January 1st, of $250,000. Add in the earnings available to common shareholders for the current year, which we had as $100,000 that we calculated. Deduct from that cash dividend declared and paid in the year. So the board of directors decided of the $100,000, we're going to give $50,000 of it to our shareholders, basically 50 cents for each share of stock that you own. Okay, so now we have to do the math. 250,000 plus 100,000 is 350,000, minus 50,000 gives us $300,000. So at the end of the year, our company has retained $50,000 of our profit for future growth in the company. We gave $50,000 as dividends to our shareholders to keep them happy so that they feel that they're sharing in our profits. And we also paid our preferred dividends to our preferred shareholders. We paid all of our expenses. It was a good year. Okay, it was a good year. We paid all of our expenses, made all of our ownership groups happy, and were able to add to retained earnings. Okay, I've run out of time for today. I think we're at very close to 10 minutes to 11, which is when the class ends. Let's hold it there. We'll pick up again on Thursday. Thursday will be remote again. My son is doing better, but as of this moment, there is no plan for discharge yet. So still be remote as of Thursday. I'll keep you posted as to any changes to that. Any questions? This is exciting stuff, isn't it? I hear it from, I hear each and every one of you. If you'd have your mics on, you'd all be just jumping up and down with how excited you are with this class today, especially you, Owen. I can see you doing it.
Strangely enough, I am actually smiling and chuckling a little bit.
Well, you're going to learn some tools in here that are going to make it easier for you to run your companies. So, all right, so we'll end it there for today. Have a great rest of the day and tomorrow, and I'll see you guys same time on Thursday, right here on Zoom.
Have a good day.
Have a good day.
Thank
Have
you.
a good day.
Thanks, everybody.